2023 will be a very interesting year because you do have the potential to get some really great deals. But there are a lot of real estate choices out there. Which one makes the most sense? In this video, I'm going to be walking you through my methodology in figuring out where and what to invest in. But before I continue, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Here we have Windsor, Barrie, Guelph, and some other options in the GTA. First off, you can see that the price varies quite a lot. So if you are limited by budget, then it gets easier actually because you end up getting less to choose from. And from there, I prefer choosing the ones with the best risk-adjusted returns. But what does that mean? Well, even if there are similar returns, one might see better cash flows and another might see better appreciation. And if that's the case, I would definitely go with the one with the better cash flows, and it's pretty easy to explain why these days. Higher cash flows can help you in case your monthly costs go up, and so it ends up being a safer investment. From a high level, you can see that the GTA does give better total returns compared to the smaller towns in Ontario. But let's dig into cash flows. It turns out smaller towns have the edge here with better cash flows, but because appreciation makes up more of the returns pie and they do see lower long-term appreciation, that's why their total returns end up being lower. That 2.5% difference in returns before leverage is actually quite a big deal. If the purchase is $1 million, that's $25,000 more per year. And because of that, I am leaning towards the GTA here as long as holding power is strong. In the GTA, 416 properties do see better cash flows than the 905, and that's because city renters often are willing to pay a premium to live closer to the core. And then within the 416, semis and detached homes don't see big differences in rents, but you end up buying semis for a discount. And so semis end up seeing better cash flows too. From a risk-adjusted return standpoint, I personally feel that a safe level of cash flows need to be slightly positive. I'm not looking for major cash flows to fund my lifestyle, but 2.5% less in returns before leverage is a lot if I do choose the smaller towns. So given that 416 semis do have positive cash flows and higher long-term returns, they do seem to be the best risk-adjusted choice here. Now, total returns is largely based on appreciation, so we should get a better understanding of what's happening here too. Working with what we've got from CREA between 2005 to 2020, the GTA has seen the best growth. Then, once the pandemic hit, combined with record low interest rates, we saw much faster growth in the suburbs, especially in areas with lower purchase prices. And you can see it clearly here if we use 2020 as the baseline, and you can tell that these small towns all rose more compared to the GTA. You can also see that within the GTA, the 905 detached homes also went up higher than the 416. Now, if those big price gains overstretched because of low rates in the suburbs and smaller towns, then it is possible to see an unwinding now that mortgage payments are much higher. And if that's the case, then there could still be more room for prices to come down. Just remember, analyzing data is tricky. If you choose different start and end times, especially with shorter time frames, you might end up seeing completely different results. And so the time frame can make a huge difference. If you believe that there was a permanent COVID shift in prices because more people are still working from home nowadays, then maybe the start of 2020 shouldn't be the baseline anymore. Now, if we make 2021 the reset time, the story gets changed again. You can see that condos still have a lot more room to drop, but the drop in 905 detached homes isn't actually that far off from the 416 anymore. I don't know which story is more accurate, but I really like to defer to fundamentals to process my thoughts in these cases. When rates go up, the biggest drops will happen in markets that are the most stretched. Because the suburbs went up so much more since 2020 compared to the 416, and these properties are usually in the starter home neighborhoods where homeowners do have a higher debt ratio, I think that it is pretty likely that they are more stretched than 416 house owners. We also know that there's also more speculative buying in condos, and more investors were already in negative cash flow positions before rate hikes. And so both of these types of homeowners are probably very tight on cash. And based on these assumptions, I would suspect that these suburbs and condos should see bigger drops compared to the houses in the 416. I always think that timing the market is extremely hard, and we usually buy when we're ready. If you can afford 416 semis, then they are the best long-term risk-adjusted investment choice here, and the charts tell us that we might actually be closer to the bottom here. But if you need to buy in the suburbs or you need to buy a condo, then it is possible to see prices come down more in the coming months. Here's another thing. If you do have a lower budget to work with and you are choosing between Toronto condos or smaller townhouses, then the smaller townhouses is probably the safer bet here. You do see similar total returns, but better cash flows in the houses, so the smaller townhouses do make more sense here. Plus, keep in mind that there's also more things you can do with a house, like adding extra rooms, adding extra rental units, or even taking on build projects on the land you own. These things can give you a bigger and faster bump in appreciation, and these are just things that you cannot do with condos. As we kick off another year, you might be planning your real estate investing roadmap for 2023, so hopefully this helped you figure more things out. And if you're looking to invest in Toronto and want to bounce ideas off of our sales team, just reach out to us. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations, and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching, and see you in the next video.